Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is David, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the Risk Spotlight Portal, the premier forward-looking service for operational risk content. Let's get started. In the ever-evolving financial services industry, AI adoption continues to expand, reshaping operational risk considerations. According to the 2024 F5 State of Application Strategy Financial Services Edition report, over 80% of financial institutions are now integrating AI into their systems. While AI promises efficiency and personalized experiences, the report highlights concerns around model performance. Poorly optimized AI models can lead to latency, impacting consumer experience more than even cost considerations. To mitigate this, financial institutions are increasingly focusing on AI ops, using telemetry and automation to streamline operations and reduce human error. Another key area covered in the report is API security. APIs are at the heart of financial services digital transformation, with organizations managing an average of 601 APIs. However, the rapid expansion of APIs comes with risks, including unmonitored zombie APIs and security vulnerabilities. As a response, 45% of financial institutions are now deploying API discovery capabilities to maintain control over their digital ecosystems. As API usage grows, institutions are expected to strengthen security measures to protect sensitive data and prevent potential breaches. The report also touches on the rise of hybrid multi-cloud environments, which offer flexibility and resilience. However, 95% of financial institutions report challenges with managing multi-cloud deployments, particularly in maintaining security and operational efficiency. With AI workloads becoming a key driver for multi-cloud adoption, institutions must ensure their cloud strategies align with security and cost-effectiveness. Staying with the topic of technology, a major concern emerging in Europe is the risk posed by quantum computing to current encryption methods. Europol recently warned that financial institutions must begin planning for the transition to quantum-safe cryptography. The concern is that malicious actors may already be storing encrypted data with the intention of decrypting it once quantum computing becomes viable, a risk known as store now, decrypt later attacks. In response, Europol's Quantum Safe Financial Forum, QSFF, has issued recommendations urging policymakers and financial institutions to prioritize quantum-safe cryptography. Improved coordination, a voluntary regulatory framework, and a forward-looking cryptography management strategy are recommended. Cross-border collaboration and knowledge sharing are essential for effective implementation. The UK and US have already taken steps towards developing post-quantum cryptography standards, with the US National Institute of Standards and Technology, NIST, formalizing the first 3 quantum-safe algorithms last year. Turning to regulatory compliance, financial institutions are facing increasing scrutiny around anti-money laundering, AML, and Bank Secrecy Act, BSA, compliance. The Federal Financial Institutions Examination Council, FFIEC, continues to stress the importance of periodic AML-BSA audits, with a focus on independent testing, compliance training, and transaction monitoring. Regulatory bodies emphasize that institutions must conduct thorough risk assessments and ensure internal auditors remain independent from senior management. Additionally, specific areas such as suspicious activity reporting, currency transaction reports, and customer due diligence remain top priorities for regulatory examinations. As financial institutions navigate these challenges, proactive compliance measures and regular audits are essential to mitigating enforcement risks. In the U.S., a significant policy shift has occurred with the revocation of the 2023 Executive Order on AI safety. The new executive order, removing barriers to American leadership in artificial intelligence, prioritizes AI innovation over regulatory restrictions. This comes alongside a $500 billion private sector investment in AI infrastructure, spearheaded by SoftBank, OpenAI, Oracle, and MGX. A notable development in AI is the emergence of AI agents, advanced AI systems capable of automating tasks beyond traditional chatbot functions. However, legal risks associated with AI agents are becoming a growing concern. Courts are now considering liability issues where AI systems make autonomous decisions with potential consequences for both vendors and businesses that deploy them. Companies looking to integrate AI agents must carefully assess contractual agreements, privacy risks, and compliance with emerging AI regulations. The evolving regulatory landscape isn't just impacting AI. A recent executive order by President Trump, titled Strengthening American Leadership in Digital Financial Technology, aims to support blockchain and digital asset growth. The order revokes previous regulations perceived as restrictive to the crypto industry, instead promoting regulatory clarity and financial inclusivity. Key provisions include the protection of fundamental blockchain activities such as self-custody and mining, a review of digital asset regulations, and a ban on the establishment of a U.S. central bank digital currency, CBDC. The executive order signals a significant shift in U.S. digital asset policy, which could encourage greater institutional adoption of cryptocurrencies. Major financial institutions are closely watching these developments, with firms such as Bank of America indicating they may increase engagement if clearer regulations emerge. Meanwhile, regulatory oversight in traditional finance continues to tighten. The Financial Industry Regulatory Authority, FINRA, has released its 2025 Annual Regulatory Oversight Report, which introduces a new focus on third-party risk management. As financial institutions become more reliant on external vendors, the report highlights the growing risk of cyber attacks and service disruptions among third-party providers. Firms are urged to strengthen vendor oversight, conduct thorough due diligence, and incorporate third-party vendors into cybersecurity response plans. The guidance also addresses the risks associated with fourth-party vendors, where firms must ensure transparency and accountability throughout the supply chain. Compliance teams must take proactive steps to align their third-party risk management strategies with FINRA's evolving expectations. Finally, recent policy changes in the U.S. Department of Justice, DOJ, have significant implications for corporate diversity, equity, and inclusion, DEI, initiatives. A new executive order mandates the elimination of DEI-related policies within government agencies and federally funded institutions. This directive could have ripple effects on corporate DEI programs, particularly those that receive government contracts. Businesses should closely monitor these developments and assess any legal risks associated with DEI-related policies. Now let's turn to key operational risk loss events reported last week. The first update is on a major legal reversal in Portugal's banking sector, where 11 major banks have been spared from paying €225 million in fines for mortgage collusion. The Lisbon Court of Appeal dismissed the penalties this week, citing expired statute of limitations tied to their 2002-2013 coordination on loan terms, which impacted over a decade of housing market competition. Among the institutions involved, state-owned Caixa Geral de Depósitos faced the largest individual fine of €82 million. Millennium BCP was assigned a €60 million penalty, while Santander Tata and Banco BPI, owned by Spain's CaixaBank, were fined €35.65 million and €30 million, respectively. While Portuguese regulators may still challenge the decision, this ruling removes immediate financial liabilities for institutions collectively controlling nearly 80% of the country's mortgage market. The next update is on Barclays facing fresh regulatory scrutiny in the UK over its anti-money laundering systems. The Financial Conduct Authority launched a probe this week into the bank's treatment of high-risk clients, just months after issuing a £40 million penalty for similar control failures. This marks the second major AML-related investigation into Barclays in under 2 years, raising concerns about repeated compliance weaknesses in handling financially risky customers. The next update is on South Korea's intensified crackdown on illegal short-selling practices, with global banks like JP Morgan, Morgan Stanley, UBS, and Nomura facing fines totaling $11 million for violating rules around naked short-selling in the domestic stock market. This comes as regulators prepare to lift a temporary ban on short-selling in March 2025, implementing stricter surveillance systems to curb market manipulation and protect retail investors. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.